The room went silent the moment the word halt hit the wires. In Brussels, officials who had spent months smoothing language and softening edges suddenly froze as the headlines exploded across global markets. The European Union was stopping negotiations on a major trade deal with the United States. Not slowing down, not reconsidering, halting. And behind that single word was a deeper tremor shaking the transatlantic alliance, new tariff threats from Donald Trump. What had been framed as tough negotiating tactics now felt like a collision course between two economic superpowers that had long called each other partners. This was not just policy, it was power, it was pride, and it was a high-stakes gamble with global consequences. The relationship between the European Union and the United States has always been layered: strategic allies, military partners, economic competitors, political sparring partners. For decades, trade flowed back and forth across the Atlantic in staggering volumes, binding the two economies together in ways few regions could match. Supply chains stretched from Midwestern factories to German auto plants, from French vineyards to American grocery shelves. The numbers were massive, but the symbolism was even larger. The transatlantic bond represented stability in a world often defined by volatility, now that stability was under strain. Donald Trump, the former U.S. president and now a dominant force in American politics, once again reignited one of his signature strategies: tariffs as leverage. During his presidency, Trump had repeatedly argued that America was being taken advantage of in trade relationships, particularly with Europe. He framed tariffs not as punishment, but as correction, a way to rebalance what he saw as unfair advantages and lopsided agreements. His supporters called it strength. His critics called it economic brinkmanship. And now, with new threats circulating, Brussels was responding in a way few expected, by pulling the emergency brake on negotiations entirely. The timing could not have been more dramatic. Talks had been inching forward after years of tension. Both sides had signaled cautious optimism. Diplomats spoke in carefully measured tones about constructive engagement and mutual benefits. Businesses on both continents were watching closely, hoping for reduced barriers, smoother regulations, and expanded access. Instead, they woke up to uncertainty. Markets reacted in flashes of red and green. Analysts scrambled to interpret what this meant. Was this a temporary pause, a strategic maneuver, or the beginning of a deeper fracture? Inside the European Commission, there was growing frustration. Officials privately expressed concern that new tariff threats undermined trust at the negotiating table. From their perspective, serious talks cannot coexist with threats of economic punishment. The EU has long positioned itself as a defender of rules-based trade, insisting on predictability and multilateral frameworks. When tariffs are deployed suddenly, particularly against long-standing partners, it disrupts not just commerce but confidence, and confidence is currency in international trade. Trump's rhetoric, however, has never been subtle. He has consistently argued that tariffs are a negotiating tool designed to bring partners back to the table on American terms. He often points to instances where tariff pressure preceded new agreements, claiming it proves his method works. To his political base, the approach signals toughness and refusal to accept what they see as weak compromises. The message is simple: America first, negotiations second. The question now is whether that strategy can coexist with an EU that is increasingly assertive about defending its own interests. The transatlantic trade relationship is enormous. Hundreds of billions of dollars worth of goods and services cross the ocean every year. European car makers rely heavily on American consumers. U.S. tech giants depend on European markets. Pharmaceutical companies, agricultural exporters, aerospace manufacturers, each has a stake in the delicate balance of tariffs and regulations. When threats surface, even before policies are implemented, businesses begin adjusting. Orders get delayed. Investment decisions are reconsidered. Uncertainty becomes its own form of tax. What makes this moment especially volatile is the political backdrop. In the United States, trade has become a powerful campaign issue. In Europe, economic resilience has become a strategic priority after years of pandemic disruption and geopolitical tension. Neither side wants to appear weak. Neither side wants to concede ground, and both are navigating domestic audiences that are deeply skeptical of compromise. The EU's decision to halt talks sends a signal that it is willing to play hardball as well. Rather than continuing negotiations under pressure, Brussels is essentially saying stability first, threat second. It is a calculated move designed to shift leverage back toward predictability. By pausing discussions, the EU forces Washington to confront the consequences of escalating rhetoric, but it also risks deepening the standoff. Behind closed doors, diplomats on both sides are likely calculating scenarios. If tariffs are imposed, what retaliatory measures would follow? The EU has previously responded to U.S. tariffs with targeted countermeasures on iconic American products, from agricultural goods to consumer brands. Retaliation can quickly spiral into tit-for-tat escalation, raising costs for businesses and consumers alike. History shows how rapidly such cycles can intensify once they begin. The global context adds another layer. At a time when economic alliances are being reshaped and supply chains are being reconfigured, a rift between the US and EU could send shockwaves beyond their borders. Emerging markets watch closely. Competitor economies analyze every signal. If transatlantic unity weakens, others may see opportunity. Trade is not just about numbers, it is about influence. There is also the question of credibility. For years, both sides have emphasized their shared commitment to democratic values and economic cooperation. When disputes escalate publicly, that narrative becomes harder to sustain. Allies begin to question reliability. Businesses question long-term planning. Investors factor political volatility into financial models. Yet this moment is not purely destructive. It is also revealing. It exposes the underlying tensions that have simmered for years beneath diplomatic smiles. Disagreements over digital taxes, agricultural standards, industrial subsidies, and regulatory frameworks have never fully disappeared. They have simply been managed. Trump's renewed tariff threats bring those disagreements back into sharp focus. In Washington, supporters argue that Europe benefits disproportionately from trade access to the American market. They point to trade deficits as evidence of imbalance. European officials counter that trade balances are influenced by complex factors, including currency values, consumer demand, and investment flows. The debate is not new, but the tone is sharper now, amplified by campaign politics and economic anxiety. Financial markets respond not only to policy, but to perception. The perception of instability can drive currency fluctuations and stock volatility. Investors crave clarity. When trade negotiations stall abruptly, clarity evaporates. Analysts attempt to read between lines of official statements, searching for hints of compromise or escalation. Each press conference becomes a potential turning point. The human dimension is often overlooked in high-level trade disputes. Factory workers, farmers, small business owners, they feel the impact first. A tariff on imported components can raise production costs for manufacturers. Retaliatory tariffs can shrink export markets for agricultural producers. Consumers may see higher prices on everyday goods. The ripple effects spread quietly but persistently. As the EU halts negotiations, questions multiply. Is this a tactical pause designed to reset the tone, or is it a signal that trust has eroded too far? Can back-channel diplomacy repair momentum, or are both sides preparing for a prolonged standoff? Trump's political calculus is equally complex. By threatening tariffs, he energizes supporters who view aggressive trade policy as a defense of American sovereignty. But he also risks alienating business leaders who prefer stability. The balance between political messaging and economic impact is delicate. The same move that excites a rally crowd can unsettle corporate boardrooms. European leaders face their own internal dynamics. The EU is not a single nation, but a union of 27 member states, each with distinct economic priorities. Some countries rely more heavily on exports to the United States than others. Achieving consensus on how firmly to respond to U.S. threats requires careful coordination. Unity is strength, but unity can be fragile. In the background looms a broader strategic question. What does the future of transatlantic trade look like in an era of rising protectionism? The post-World War II model of ever-deepening liberalization has faced growing skepticism. Populist movements across continents challenge the premise that free trade automatically benefits all. Political leaders respond to those sentiments with policies that emphasize national interest. And yet, complete decoupling between the US and EU is neither realistic nor desirable for either side. Their economies are deeply intertwined. Investment flows run both ways. Millions of jobs are connected to transatlantic commerce. The stakes are simply too high for a permanent rupture. That reality creates both tension and incentive. Tension because neither side wants to appear dependent. Incentive because neither side can afford collapse. The EU's halt is therefore both a warning and an invitation, a warning that negotiations cannot proceed under threat, an invitation for Washington to recalibrate its approach. Whether that recalibration occurs depends on political calculations unfolding in real time. Public messaging from Brussels emphasizes commitment to fair and balanced trade. Statements stress readiness to defend European interests while remaining open to dialogue. The tone is firm but measured. Officials avoid inflammatory language even as they underscore seriousness. In the United States, responses vary along partisan lines. Some lawmakers applaud a tougher stance. Others caution that escalating trade tensions with allies weakens America's broader strategic position. Business groups urge calm and predictability. The debate spills across media platforms, shaping public perception. Meanwhile, supply chain managers watch shipping schedules. Currency traders monitor exchange rates. Executives reevaluate expansion plans. The halt in negotiations becomes more than a headline. It becomes a variable in complex economic equations. There is also the psychological dimension. In negotiations, perception of strength can be as important as actual leverage. By halting talks, the EU signals that it will not negotiate under duress. By threatening tariffs, Trump signals that he is prepared to escalate. Each side attempts to shape the narrative of resolve. Behind the drama lies a simple truth. Trade disputes are rarely resolved through rhetoric alone. They require painstaking technical work, line-by-line analysis of tariff schedules, regulatory standards, and dispute mechanisms. That work depends on trust and continuity. When talks halt, momentum dissipates, and yet moments of tension can sometimes accelerate breakthroughs. History shows that crises occasionally force clarity. When stakes become undeniable, compromise may emerge from necessity. Whether this situation evolves toward confrontation or compromise remains uncertain. For now, the image is stark. Brussels pressing pause, Washington issuing warnings, markets bracing, and the transatlantic relationship entering another chapter of uncertainty. The halt is not the end of dialogue, but it is a dramatic shift in tone. It underscores how fragile even the strongest alliances can become when economic strategy collides with political ambition. The coming weeks will test not only negotiators but narratives. Will this be framed as a temporary tactical dispute in a resilient partnership, or as evidence of deeper structural divergence? Leaders on both sides understand the symbolic weight of their decisions. Every statement carries implications far beyond immediate policy. As headlines continue to flash and analysts debate scenarios, one reality stands out: trade is power. And when power is contested, alliances are tested. The EU's decision to halt the deal amid new tariff threats is more than a bureaucratic maneuver. It is a declaration that the terms of engagement matter as much as the outcome. The next move will determine whether this confrontation becomes a prolonged standoff or the catalyst for a recalibrated, perhaps even stronger, transatlantic partnership. In the days following the announcement, the atmosphere shifted from shock to calculation. Governments, corporations, and investors began modeling outcomes with clinical precision. What would a new round of tariffs actually target? Steel and aluminum once again, automobiles, agricultural exports, technology components. Each sector carried its own political symbolism and economic ripple effects. The uncertainty itself became a strategic instrument hovering over boardrooms like a storm cloud that refused to break. European officials quietly intensified internal coordination. Trade ministers from major economies such as Germany and France held urgent consultations, weighing both defensive and retaliatory options. For export-driven industries, access to the American market is not a luxury, but a pillar of growth. The automotive sector in particular watched developments with unease. A tariff hike on vehicles or parts could reshape pricing strategies overnight. Supply chains that took decades to optimize could be forced into abrupt redesign. Across the Atlantic, American manufacturers considered their own exposure. Many rely on European machinery, specialized components, and high-precision equipment that cannot easily be sourced elsewhere. Tariffs imposed on those imports would not simply penalize foreign competitors, they could increase costs for domestic producers. This dual-edged nature of trade barriers is what makes them politically powerful but economically complex. The broader financial system also reacted. Currency markets assessed whether escalating trade tensions might weaken the euro or strengthen the dollar, or vice versa. Bond investors evaluated potential inflationary pressures if tariffs drove up consumer prices. Stock indices reflected shifting sentiment with every new comment from political leaders. The language of diplomacy was now intertwined with the language of capital flows. For Donald Trump, the moment carried strategic symbolism. His trade philosophy has long centered on leverage through disruption. By threatening tariffs, he asserts negotiating dominance, compelling counterparts to reconsider their positions. Supporters argue that without such pressure, entrenched trade imbalances would persist indefinitely. Critics warn that repeated use of tariff threats erodes trust and undermines alliances that extend beyond economics into security and geopolitical cooperation. The European Union's halt can be interpreted as a counter-strategy aimed at denying that leverage. By stepping back from negotiations rather than accelerating them under pressure, Brussels attempts to redefine the playing field. The message is subtle but clear: negotiation requires stability. Whether this approach strengthens the EU's hand or prolongs the impasse depends on how Washington responds. Domestic politics on both sides intensify the stakes. In the United States, trade disputes resonate with voters who feel globalization has disadvantaged certain communities. Tariff rhetoric can energize those constituencies. In Europe, leaders must balance national interests within the broader union framework. Countries with stronger export exposure may push for de-escalation, while others prioritize standing firm against perceived coercion. Achieving consensus within a bloc of 27 nations is itself a delicate diplomatic exercise. The psychological warfare element cannot be ignored. Public statements are crafted not only to inform, but to influence perception. Each side seeks to project resilience. Each side signals readiness to withstand short-term pain for long-term gain. Markets attempt to decode tone and nuance, sometimes reacting to a single adjective in an official communiqué. Meanwhile, global competitors observe carefully. When two of the world's largest economic powers clash, space opens elsewhere. Emerging economies may seek alternative trade partnerships. Rival powers may attempt to exploit divisions. The geopolitical chessboard shifts subtly with each tariff threat and countermeasure. Trade policy, once confined largely to economic ministries, now sits at the center of strategic competition. Business leaders increasingly call for predictability. For multinational corporations, the cost of uncertainty can exceed the cost of tariffs themselves. Long-term investments require confidence in regulatory stability. When trade frameworks appear volatile, companies may delay expansion or redirect capital to less contentious regions. That hesitation can slow economic growth in ways that are difficult to quantify but deeply consequential. At the consumer level, the narrative often crystallizes around prices. Tariffs can raise costs for imported goods, and retaliatory measures can affect exports that support domestic industries. Inflation concerns amplify political sensitivity. Leaders must weigh the optics of defending national interests against the tangible impact on household budgets. Diplomatic channels remain open even amid public tension. Behind-the-scenes conversations continue through embassies and trade representatives. Experienced negotiators understand that public posturing often masks private pragmatism. The halt in talks does not eliminate communication, it alters its tempo. Informal discussions may lay groundwork for eventual compromise. The strategic calculus extends beyond immediate trade balances. Transatlantic cooperation spans defense, intelligence sharing, climate initiatives, and technological standards. Prolonged economic friction could spill into these domains, complicating coordination at a time when global challenges demand unity. Policymakers are acutely aware of this interconnectedness. The European Union's institutional structure also shapes its response. Trade policy is centralized at the EU level, giving Brussels significant authority. However, implementation and political consequences reverberate within member states. National leaders must explain the halt to their constituencies, framing it as defense of fairness rather than escalation. Messaging discipline becomes essential. In Washington, internal debates likely unfold between economic advisors, political strategists, and industry representatives. Some may advocate measured escalation to extract concessions. Others may counsel caution to preserve alliance cohesion. The balance between campaign positioning and governing responsibility influences decisions. Historical precedents provide mixed guidance. Past trade disputes between the U.S. and Europe have eventually been resolved through negotiation, often after periods of tension. Yet each episode leaves residual effects on trust. Repeated cycles of threat and retaliation can normalize volatility, making markets more reactive and diplomacy more brittle. Technology and digital trade represent emerging fault lines. Disagreements over data governance, competition policy, and taxation have simmered for years. Tariff threats risk intertwining with these issues, complicating resolution. As economies become increasingly digital, traditional tariff tools may intersect with regulatory disputes in unpredictable ways. Energy markets add another variable. Europe's recent efforts to diversify energy sources and enhance resilience intersect with trade policy. If tensions escalate, energy cooperation could become entangled, amplifying economic consequences. Strategic autonomy remains a recurring theme in European policy discussions. Public opinion influences momentum. Media coverage frames the narrative as confrontation or negotiation. Social media amplifies reactions instantly. Political leaders must navigate not only economic realities but perception cycles that move at digital speed. A single tweet or speech can trigger market swings within minutes. Despite the intensity, pathways to de-escalation exist. Confidence-building measures, temporary tariff suspensions, or phased negotiation frameworks could restore momentum. Both sides possess incentives to avoid a full-scale trade war. The scale of mutual investment creates a gravitational pull toward compromise, even if rhetoric suggests otherwise. Yet compromise requires timing. If either side believes domestic political advantage lies in sustained confrontation, resolution may be delayed. Trade policy often becomes a proxy for broader ideological debates about globalization, sovereignty, and economic justice. In such environments, technical solutions alone may not suffice. As weeks unfold, the narrative may shift from halt to recalibration. Negotiators could re-engage with revised mandates. Tariff threats might be softened or redirected. Alternatively, escalation could crystallize into formal measures, triggering retaliatory responses and prolonging uncertainty. The trajectory remains fluid. For businesses and citizens, the stakes are tangible. Jobs linked to exports, prices linked to imports, investments linked to stability, all hinge on decisions made in political capitals. Trade policy may appear abstract, but its consequences are deeply personal. In the end, the halt of the US-EU trade deal negotiations amid renewed tariff threats represents a defining moment in transatlantic relations. It tests assumptions about alliance durability, it probes the limits of economic leverage, it underscores how rapidly confidence can erode when rhetoric intensifies. The outcome will shape not only tariff schedules, but the broader architecture of global trade. If managed carefully, this episode could lead to clearer terms and renewed commitment. If mishandled, it could entrench mistrust and fragment cooperation. For now, the world watches as two economic giants reassess their footing. The silence after the word halt still echoes. The next word spoken, whether conciliatory or confrontational, will determine whether that silence becomes a pause before progress or the prelude to prolonged conflict.